This is a lecture from Open Tuition.
This lecture looks at question 2 of the March 2020 Advanced Performance Management Examination. You are strongly advised to download the question paper before looking at this lecture and to read through the question, making rough notes about what you would have said were you confronted with this in the exam. Then when I go through the question and we look for perhaps hints as to what the examiner is looking for, or indeed focusing on the explicit requirements, then you'll be able to compare, what you thought was required with what I think is required, and to identify where you may have gone astray. So, always look at the requirements first. This gives us some idea, roughly what is the question about. Is it to do with, the likelihood of a company failing? Is it to do with transfer pricing? Or, as in this case, is it to do, we will eventually see, I think with VBM, advisor directors and implementation of step 2 of VBM as requested. And we go to the requirements. We might not know what VBM is immediately. Hopefully the question will tell us that. And evaluate both whether TOTEG has created value and the difficulties of using EVA as a performance indicator. So let's see if we can find a little bit more about what step 2 of VBM is. Hopefully we made it explicit to us, but slightly panic making perhaps at the start, just a little bit. So let's read the question. TOTEG manufactures high quality and innovative small electrical appliances such as hair dryers, vacuum cleaners. So it's high quality in here. And innovative. So the chances are that these are pretty important qualities or properties that the company is pursuing, and it's probable that these will remain important. All of the board of directors, who are the strategic decision makers, have always worked in the business and are members of the TOTEG family. Most of the operational managers joined as factory workers when the business started and have taken on more responsibilities as the business has grown. It may not be relevant, but the feeling is here a fairly closed-in sort of a business. You start working in the business when you're 16 or whatever, and you kind of retire when you're 65 or whatever. All the board of directors are family members. Other questions might, we don't know about this one yet, might begin talking about potential shortcomings in the management of the company. That's maybe too insular. We don't know. TOTEG has a basic and outdated IT system. Almost certainly that bad news is going to be relevant, and has always used traditional performance measures such as return on investment and operating profit margin. It has historically had few competitors, and the directors have focused on improving financial results from one year to the next with little long-term planning. Living from year to year, almost, as they could do if there was no fierce competition around. A number of overseas competitors have, however, recently entered the market. It's estimated within 1 year that these competitors will produce to a similar cost, and within 3 to 5 years, quality will be matching that of TOTEG's products as well. So the writing's a bit on the wall here for this relaxed management style. Competitors will be able to compete on cost very quickly and on quality within a number of years. TOTEG may have to invest heavily in product development and make acquisitions in the future. Probably implying that it's going to have, maybe a little bit of a dip in profitability. The investment in product development is likely to cost money, which is going to hit the profitability of the company and the like. Usually with acquisitions, there's disruption costs, acquisition costs, and so on. So it's potentially going to be a tough couple of years in terms of maintaining performance. A consultant has recently told the directors that implementing VBN, and there we see this is value-based management, will help to respond to the increase in competition over the next 1 to 5 years, and has defined VBM as the alignment of business strategy, management process and culture, focusing on the key drivers of value. So I think this here is going to be important. What causes value? What causes good profits? What causes a good return on investment? If the company was quoted, and I don't think it is, it seems more like a largish family company, but what would cause an increase in the share price and the wealth of the public shareholders? The directors have accepted this as a reasonable definition of VBM, and most now agree that VBM would be useful, though others are not as convinced. The directors have, however, asked you for further advice on one aspect of the implementation of VBM at Torteg. At a recent presentation, the consultant presented a slide showing the 4 steps. Well, let's run off to that and find out a bit more about this mysterious VPN. So here we have produce a strategy for maximizing value. For example, it could be a strategy of continuing to differentiate, making high quality, rather special products and selling them for a reasonable amount of money. Define performance targets, create a plan to achieve those targets, and then let's set up measures and reward systems so we can basically incentivize people to try and hit those targets. And it's stage 2, which the director wants us to advise on, defining performance targets. In particular, it should be the selection of targets and measures. And I'm assuming that this is, what do we measure and how do we know how good it should be? What should the specific target be? Or how do we say that, we for example, we want a gross profit of 15%, and really anything below 15% isn't good enough. The timescales to which the target should relate. Management levels, strategic and operational, in the business to which the target should relate. And difficulties in measuring and manage performance using VBN. Then, finally, measuring value. Directors are unsure of a suitable financial performance indicator for them to use. As an illustration, they've asked you to evaluate by calculating the economic value added, whether it has generated value for the last year. You should use the financial information given in Appendix 2 and advise on the difficulties of using it. So there's 2 things in this here. There is calculating EVA and is looking at the difficulties. So advise the directors on the implementation of step 2 as requested. So this was basically these 4 elements here to be looking at. And to some reason it's a bit like question 1. We have kind of always key mission, key objectives of the company, which presumably to be ultimately a sustainably profitable company. But we have to say this is now in the face of this competition, and we have to probably maintain our current market standing, if you like. So what is going to be basically playing in to this value-based management, which we're asked to set up targets for here. At the minute, all they do is look back. They look at the historical figures here of return on investment and operating profit margin. And as I said, I think in question 1, neither of those tells us what produces good ROI and what produces a good profit margin. These are very much the scorekeepers of what we've done. We know that the company is well known for producing high quality and innovative small electrical appliances. And I think it's fair to say that historically, these were probably the cause of the company's success. And unless our strategy is to radically veer away from this historical success story, I think that innovation and quality will remain important to this company. And therefore, what we need to do is, for some of these targets, appropriate measures and targets, to establish measures for quality and measures for innovation, and to set certain targets for quality, like maybe the number of rejects, and we could even argue this could be divided between failing in-house and failing with the customer, and so on. If innovation is important to the company, then we need to set targets for innovation. And these targets could be the number of new products launched in a year, could be how long it takes to develop a new product. It could be the amount of money we spend on R&D, so we're kind of forced to keep research and development investment going. It could be the number of patents which have been filed. Any of these would allow us to keep a watch on ensuring really that we remain innovative, that we don't kind of rest back and relax and let the old products sell, and of course the sales are going to go down and down and down. So that was what always should have been measured, really. But let's think now what's actually happening in this business. And we have this threat from these suppliers coming from abroad. And what we have is these people now who are going to be able to compete on cost. And they're going to do that within a year. And really, we have to be able to compete on cost as well. If these people are going to compete with us, they will have to be selling, to some extent, equivalent products in terms of quality. And of course, you could get into saying, well, if these people are coming in and selling lower quality, more ordinary, kind of cost leadership type of products, we don't quite need to compete in cost to the same extent. But the element of cost, the importance of cost, has elevated a little bit. If we are charging 50% more than these competitors, then suddenly our customers are presented with a choice, and they have to see whether they maybe want to pay 50% more for our products than they would have to pay for competitors' maybe more basic but adequate products. So I think we're going to have to start looking at costs. And then there is quality. And we've always looked at quality, but maybe we've had placed ourselves a little bit. When we come to be looking at quality, we now have to make sure that our goods are as good in terms of quality as these competitors' goods which are going to be coming in. And we may also have to extend it a little bit into areas like customer service. If our competitors can satisfy orders within a day, then maybe we need to be doing the same. Again, there can be this kind of conflict, if you like. If we're keeping an eye on cost and we're keeping an eye on quality, keeping the cost down, we have to make sure it's not done at the expense of cuts in quality or cuts in maybe amount spent on innovation to keep your profit high. And certainly when you're establishing new measures and targets, it's important not to put too much emphasis in one measure and target. You need a whole kind of raft of measures and targets to ensure that the company performs in a whole lot of different areas to an adequate extent. So these measures and targets are kind of to help the company look forward, so that it will be doing now what is needed to stand up to this competition in the future. Timescales to which a target should relate. And I think the timescales are timescales necessary to make a difference or to defend yourself. So we're told that our competitors will be able to compete on cost within a year. And therefore we have to be able to compete on cost within a year. If competitors' products are of the same standard and innovation and quality, if you like, as ours, that's really quite a short time scale to ensure that we hit the cost targets. The quality one is a little bit more relaxed. It says 3 to 5 years. But I would be reluctant to maybe advise them that although they have time on their side, they should go right up to the 3 or 5 years. And then suddenly confront a competitor coming in with products of a similar standard. Maybe what they should do is to try to improve quality if they need to within 2 years. So that really they're ahead of the game by the time 3 years comes ahead and makes competitors have to run to catch up with them rather than the other way around. The third one to look at is management levels, strategic and operational, in the business to which a target should relate. Well, if we look at cost, cost will be incurred in purchase of raw materials. Cost will be incurred in the payment of people on the production line. Cost will be incurred in wastage. Costage will be incurred in reworking. Costage will be incurred in using or not using your staff efficiently and making sure that your machinery is fully kind of utilized. And those sort of areas of cost control are very much at an operational management, making sure the purchase manager gets a good deal, making sure that the production manager timetables the machines properly and make sure that they are properly maintained so you don't have expensive breakdowns in the middle of a production run. However, there's another element in cost control, and there was a little bit of a hint up here, I think, here, that it is outdated IT systems for a business of its complexity. And one influence on keeping costs down is your organizational skills. How you make sure there's enough raw material in stores to complete the orders which you want to make. That depends on IT. Similarly, the scheduling of machines and maybe the scheduling of staff depends on machinery. Also, although it doesn't say, we have to be a little bit careful here, but we talked about this company being quite kind of insular. We don't quite know how old their machinery is. What I'm trying to get at is to give some sort of responsibility to strategic management, that they should be the people who will be responsible for making sure that the company has the proper investments made to allow good cost control and goods of adequate or excellent quality to be made. You can't make goods of high quality on bad machinery. And at that kind of higher strategic level of IT, maybe reorganizing the way the factory is laid out, making sure you invest in up-to-date and state-of-the-art machinery, that is a much more a strategic level. The other area that we looked at particular was things like innovation and quality. Innovation, it would be, again, operationally up to the R&D department to try to design new products and so on. But maybe it's management who has to keep an eye on higher management, strategic management, has to keep an eye on what's becoming more popular in the marketplace, keeping an eye on what certain competitors may be doing, allowing the budget to be high enough in R&D to allow sufficient innovation to take place. Similarly, quality. We can have a very simple quality control system where you inspect goods at each stage and so on. But real quality and quality improvements tend to have to come through a more high-level structured type of procedures, like implementing maybe total quality management or Six Sigma or something of that type, and maybe changing the culture of the organization to emphasize that more and more quality is going to be important, because we have to beat these new pretty sharp competitors who are coming in. And finally, difficulties in measuring and managing performance using the VBM, the value-based management system. Well, it's making sure you have the right measures. It's making sure that we, of those measures, and knowing that they're going to be feeding into value. It's all very well saying I have this belief in quality, but can you show me a link between reducing rejects from 98% to 95% of good products? Can you show me the link, I beg your pardon, of increasing good products from 95 to 98? The link between that and the bottom line and increasing profits coming further on. People in this business have been used to concentrating on return on investment and profitability. There is a chance that they will be very much concentrating, therefore, on cost control and cost management. And when we start giving them targets to do with quality, to do with innovation, and the like, there may be a lack of understanding and there may be a resistance to changing the emphasis of what they are looking at to these drivers, if you like, which are assumed to be at the basis of the value-based management. Evaluate whether Totaic has created value and the difficulties of using EVA. I won't be going through the EVA calculation on the screen. There is a model answer which I have produced. This is a very straightforward EVA calculation. But the difficulties perhaps of using EVA as a performance indicator might be worth kind of looking at here. First of all, we have a problem that if you're using EVA, you need to know the WACC, the weighted average cost of capital. And if this company is not quoted, then getting a good cost of equity is going to be quite difficult, and hence getting a cost of capital is going to be quite difficult as well. Again, if you look at these notes, which you'd have looked at these notes when you're doing the EVA anyway, but down here they are considering changing the policies for depreciation. This may mean that there are inconsistencies at some point in the EVA calculations, and it'll be hard maybe to chart a trend of those from one year to the next. Also, when doing the EVA, you'd have seen that a company is financed by a mixture of equity and fixed and floating rate loans. Well, if the floating rate loans go up and down in interest rate, then your WACC is going to go up and down in interest rate. If the share price goes up and down in value, then the WACC is going to go up and down as well. So EVA will be considerably influenced by these rates of interest and the share price. Adding back things like research and development is alien to many managers, and certainly they need to be educated in what EVA is. The purpose of adding back research and development to EVA is so that people feel freer to spend on research and development, because research and development is the heart of the future of the company. If you don't spend on R&D, your company's going to have little future. But of course, in conventional financial reporting, most research and development is written off. So we'd have to certainly educate people that if you spend on R&D, and of course on things like marketing to build the brand, this will not impinge on this performance measure called EVA. So don't be frightened of spending there. It's all going to be okay. And the final criticism, perhaps, is that EVA is an absolute figure. Large companies will, assuming they're profitable, and all things being equal, large companies will create a larger EVA than small companies. And benchmarks is going to be quite important in setting these targets. You know, benchmarks about quality, benchmarks about costs. We're comparing here to these particular customers. But also, if you use EVA, we need to know whether it's kind of good or bad. We need to have some feeling, perhaps, as to whether or not we're doing okay, or whether these other competing companies seem to have much smaller, much larger EVA, and seem to be, beating us with a very large margin.